Treasury yields pairing earlier gains after June's job openings came in slightly higher than what the street had been expecting at 8.18 million. Now, the prior month's reading was revised higher. That was up to 8.23 million. We are seeing a bit of a pairing of those earlier gains. But this data, why it is so critical, is it comes ahead of the Fed's interest rate decision tomorrow. Now, the bank is largely expected to hold rates steady, but investors, of course, are going to be listening for any hints from Fed Chair Jay Powell on the path of monetary policy going forward. So joining us now to jump into all that, we want to bring in Jonathan Day. He's Newton Investment Management's global bond portfolio manager. And Jonathan, it's great to talk to you. And when we see the moves that have been coming out from the bond market, they have been largely had I think, widely speaking, of the rest of the market in terms of the Fed's expectations and what we're likely are going to hear, the timing of that rate cut. I'm curious what you think has already been priced in versus the likelihood of what we will more realistically hear from Fed Chair Jay Powell tomorrow.
Yeah, that's a good question. I mean, up until probably the early part of last week, we had, say, 2-3 rate cuts priced in over the next couple of months. And given where inflation is, given where the jobs market is, and as you just said, again, the evidence a couple of minutes ago in terms of it's a slow decline, not a serious decline, which then really means that, yes, the Fed will be cutting rates, and anyone doubts that they will be cutting rates in the next couple of months and probably in September. But that pace, I think, is still very much open to debate. And we need a little bit more. So really, towards the end of last week, we kind of got a bit more decline in yields, and that was really on the back of the equity market weakening, certainly the tech stocks. And that's when, especially given where inflation is now, where the Fed are kind of previous form in cutting rates, and cutting rates perhaps more than the market expects. But we need more, I would say, to get to the Fed to get very, very optimistic in cutting rates. And again, just early today, we're about to kind of 6 rate cuts for the next 12 months. If you roll back to November, December last year, we were in a very familiar situation, 6 rate cuts priced in. And I think the Fed will be very, very cautious about kind of playing up to the market expectations of that, because, again, what happened in January and February of this year, whereas those rate cuts got priced in, the economy started kind of turning around to that inflation spike in Q1 as well. So the market does react to rate cut expectations and where expectations where rates will be in 12, 18 months' time. So for me, the Fed will still remain quite cautious unless we get some new negative news, which still doesn't seem that apparent.
Well, let's talk about the potential negative news while we've got you, Jonathan, because you note that the Fed has been known in the past to respond to significant equity market weakness. And we've got these slew of big tech earnings on our plate for the next couple of days here. If the big tech earnings don't deliver, does that cement this rotation narrative, and therefore does that lead to a question mark from the Fed?
It all depends about the market reaction. Because that's the key thing, because certainly from US perspective, equity markets, equity wealth is very, very important to the man and woman on the street. So the Fed is ultra sensitive to it, but remains to be seen. The jury's still out and what's going to happen next. But I think we have to be careful. We have to be mindful that that is a possibility, and given where positioning is in equities as well, especially in tech stocks. So it is a possibility. It's not a central case, but it is a possibility. And the market, say towards the end of last week, the market was coming round to a little bit of that, but we're still a long way from that. The best way to do it is just keep looking at the actual data, which inflation is getting a lot better. It was not at target, but getting better. And the labour market is slowly declining, but not terminal. So that just, all those points lead to a slow decline in interest rates for cautious Fed, making sure they don't cut too quickly, because that inflation genie still hasn't disappeared.
Jonathan, talk to us about the risk of cutting too quickly or the pace of those cuts. What is your reading, even beyond this first cut? We can talk until we're blue in the face about what exactly the timing is going to look like, whether or not it's going to come in September, or if it's not going to come until right before the end of the year in December. But looking ahead to 2025, what do you think is most realistic here in terms of the pace of those cuts? And then just broadening it out even beyond the U.S. and beyond the Fed, maybe what this signals more broadly to the central banks, as you have the Bank of England and Bank of Japan here with their decisions coming up this week as well.
I think all central banks are still very wary of that. Say that inflation problem. That the direction is obviously great, and central banks feeling a lot more comfortable, but they're still going to, at the back of their minds, are going to still be very worried. As I said, Q1 of this year, on the back of rate expectations coming down very, very quickly in November, December last year, just shows us actually the economy can react quite quickly to a much more gentle, nice interest rate environment. So that is always at the back of all, not just the Fed's mind, but all central banks. And thinking perhaps a little wider afield, in those countries where mortgage markets are much more closely linked to kind of short-dated, short-end rates, mortgage markets can quickly kind of turn around as rates come down, mortgage costs come down, housing markets start picking up. So central banks will still be quite cautious. They need something else to really accelerate that pace. But at the same time, where inflation is, the direction of inflation does mean the ultra tight monetary policy we've got at the moment perhaps not quite as much needed as they have been for the last kind of 18 months, 2 years.
Jonathan, in our final minute with you, I want to ask you a personal finance question. As a bond manager,
Right.
What do you think folks who are listening to this, who've got a lot of money tied up in, say, a high-yield savings account, they're listening to this conversation about rate cuts being imminent, should they be getting out of high-yield savings accounts and instead looking at, the front end of the yield curve? What would you advise for people?
It's difficult because you think about it, whereas cash today kind of 5.5%, the 2 years now kind of around 4.4. So that already implies quite a lot of rate cuts to make that work. So I think always with bonds and investing in bonds, there's two things. One, especially when things take a turn for the worse, bonds are a great place to hide, and they're a great diversifier. They allow a smoothing of returns, reducing volatility in your own portfolio. So that's probably the best thing. It's always having a balanced portfolio. And the one thing I would say about bonds, even if you don't quite beat cash, you're still getting a 2-year bond, you're still getting 4.4%. Think about where we were in 2019, 2018, 2016, when it was kind of like 0.5%, perhaps 1% at best. So we're a long way from that. So actually, as a standalone investment, bonds, and we're talking kind of not over the next year, 18 months, over the longer term, do actually, for the first time almost in my working lifetime, actually provide a decent return. So yes, have some bonds in your portfolio. They do provide a return, and also give that nice balance to the overall risk in your portfolio too.
Yeah, can't be too mad about that four handle there, Jonathan. Thank you so much. Thank you for joining us. We really appreciate it. That was Jonathan Day, Newton Investment Management Global Bond Portfolio Manager.